Our next speaker, Anmol Singh. Ladies and gentlemen, it is my great honor and privilege to introduce our next speaker, a true master of success across multiple domains. And so as he's getting prepped for the stage, and I'll tell you a little bit about Anmol. He's the author of the best-selling book, Prepping for Success. I mean, he's got me right there, right? 10 Keys for Making It in Life. A work that has transformed mindset and trajectory of countless professionals worldwide. As a highly accomplished stock market trader and investor, Anmol has distinguished himself not just through personal success, but helping others achieve their financial goals. His unique expertise as a psychology coach for hedge fund managers has made him one of the most sought-after mentors in the financial world. To date, Anmol has coached and trained over 10,000 traders, investors, and hedge fund managers, helping them to navigate both the technical aspects of trading and the crucial psychological elements that separate the good from the truly great. He is the driving force behind the Evolve Mastermind, widely recognized as the #1 success community for ambitious professionals seeking breakthrough results. Where do I sign up? I mean, I'm almost done. You got me already, dude. Anmol's insights and achievements have been featured in prestigious publications including Forbes, International Business Times, and Business Insider. Beyond his work in the financial markets, Anmol is an accomplished angel investor who advises multiple companies, including several in which he has personally invested. He also manages a successful real estate portfolio and Airbnb business, demonstrating his versatility as an entrepreneur. Ladies and gentlemen, let's give warm welcome to a true Renaissance entrepreneur and success strategist, Anmol Singh.
All right, so today I want to talk about investing, but I want to just kind of get an idea of how many of you guys regularly invest right now in the stock market. And I don't mean like just buying a stock and holding it, but like you actually do it every month. Anybody? Good, perfect room. So the perfect room for this, I want to cover like 5 costly investment mistakes. Now I've given this presentation like a 5-hour version of it, but today I'm going to give you like the 15-minute version of it so you can start implementing it right now. So these are some of the 5 investment mistakes that a lot of people make. And the biggest one is not actually investing, right? And that's the biggest mistake. People don't actually invest in the market. You know, maybe it's like the financial code or the genetic code that we're programmed with. I was born in India, so my parents were like always thinking about the stock market as it's gambling. You know, oh, you're gonna lose all your money. You should be a doctor, engineer. What are you doing, gambling in the stock market? And I started off when I was 18 years old, and I've been trading ever since. I've never had a job, started in my dorm room, and then I joined a prop firm. So prop firms are basically a company where the company gives you their money, right? And in exchange for that money, they take a percentage of everything that you make. So I trained under them for about 5 years, and then 2015 I went off and started my own company. And now we train traders, investors. I do my own trading, manage my own capital, and I advise hedge fund managers. But the biggest thing is like people never invest, So part of it is, as I mentioned, the genetic code. We think it's gambling. We don't know where to start. We're probably going to lose all our money. And majority of the people end up doing that because we end up doing it based on hope, right? I think the stock is going to go up. I'm just going to buy more shares. It's going down. They should be getting out for a loss, but maybe it'll come back up. I read an article on Reddit. They told me to buy GameStop. Like these are a lot of the mistakes that majority people make when it comes to investing. They never actually invest, right? So, hold on. This thing's only going back, but let me go back. All right. So I want to show you, this is the percentage of Americans who regularly invest in the stock market, right? You can consistently see it's like less than 0.5%. Half of America doesn't even invest in the market. That's like leaving money on the table, right? Because inflation's at, let's say 6%, 7%. Even if you put your money in your bank account and it's earning like 4.5% or 4%, you're still losing 2%. And that 2% over the course of the years makes a huge difference, right? Huge difference, tremendous difference. And we're going to talk a little bit more about that today. So this is the chart of the S&P 500, right? So you can see here, the average person in the year 2008, when the dot-com bubble happened in 2000, and then financial crisis happened in 2008, what happened? People started movements like Occupy Wall Street, right? Occupy Wall Street. Wall Street is all gambling. They're just like greedy people. We're never going to invest in the market, right? And they vowed to never invest in it ever again. And now the average person would be broke because look at the market. So that's the financial crisis right here. We're like way higher than that. So if you never invested, you're basically losing money every day, right? And one of the things about money is like if you don't invest it, things are going to come up to take your money, right? That's just how life works. So if money's not growing, it's not like it's safe. You're actually losing money because money always finds ways to leave your account. Like, how many of you can relate to that? Yeah, right? You're sitting in the night, you see a Facebook ad, ooh, I'm gonna buy that thing. Like, you find all the things to put your money in, but we never invest in the stock market, right? We never actually let our money grow. So when it comes to investing, the second biggest mistake people make is that lack of diversification, right? Now, what do I mean when I say lack of diversification, right? So diversification means you're not putting all your money in like one stock or putting it on GameStop or something or in hoping it's gonna go up or like a crypto coin. Diversification means you have small baskets of different stocks. So maybe 10 stocks, maybe 15 stocks, and you're dividing your money into them equally, so you're not reliant on just one stock for all of your investment results, right? Now, a lot of people say, but I'm diversified. I'm like, really? What do you have in your investment account? And they say, I have some Amazon, I have Microsoft, I have Google, I have Apple. So I'm like, so you really are only in technology stocks. So that's not really diversification, because if something happens to the technology sector, well, they're all gonna go down. Now, sure, they're all gonna go up too, but if they all can go down as well, right? So the key with investing is having some diversification, meaning you have some, let's say, Microsoft, Apple, Google, you have some Tesla, maybe you have some real estate companies, you have some banks, you have some energy stocks, ExxonMobil, Chevron. So now you are diversified across sectors. So if one part of the economy goes down, you're not gonna lose all your money. Something's gonna go up, something's gonna go down. And that's how you spread your risk evenly. So we're not trading now on hope that something is gonna go up. We're really trading on the economy going up in general. So mistake number 3 is like picking stocks. Right? Now, you just said, but Anmol, you told us to pick diversified stocks, and now you're saying don't pick stocks at all. There's a reason for that. Because when it comes to stock picking, the issue is we could all here be in the exact same stock at the exact same time, but our returns are going to be vastly different based on what? Based on where we bought them, right? If you bought Tesla at $470 a share versus somebody buying it at 200, now even though we're in the exact same stocks, our returns are going to be very different based on where we bought them. So stock picking is not the right thing for most people, right? Because I do this for a living. I'm on my screen all the time. Like, we know how to read charts, we have statistics, we have odds. So it's a different game. But for the average person, I always tell them, don't even get into stock picking, right? Because if you get into stock picking, again, you have to know where to buy them as well, right? So that's the number one key when it comes to picking stocks. Now, the study shows average American is like 90% of the people pick the wrong stocks at the wrong time. Because we do it based on what? Hope, right? We read an article somewhere. I'm like, that article is like 5 months ago. What edge do you really have, right? Or if millions of people have read the article, what edge do you really have? Like, what are you really investing on, right? And I'll tell you a story. When I was like 18, 19 years old, in my dorm room, I used to write articles for Yahoo Finance, okay, or Motley Fool. So I'm like, if you're reading something online, it's probably written by a college student, right? At that time, I would be the one writing articles for all those websites, and they would make it appear like, look at this hedge fund guy writing this article, but no, they're just outsourcing it to me, right? So just be careful what you read online, okay? Because when it comes to stocks and picking stocks, the mistake number 4 is investing on emotion or gut feel, and in brackets I put which you don't have. Because what really is gut feel? Gut feel is basically our experience talking. It's giving us an inner voice like, hey, look at this. You've seen this movie before. You know how it ends, right? That's what gut feel really is when your experience is giving you that inner voice. But if you don't have experience, that's not gut feel. That's just you trading on a whim. And we don't want to trade on a whim, because otherwise your results are also going to be reliant on a whim. They might or might not happen, and we don't want to trade on hope, right? So I want to share with you this study right here. This is the Americans are terrible at investing annual study shows. Most traders and investors who just try to pick stocks on their own are going to underperform the market. Meaning you're better off just buying the S&P 500 and don't even look at stocks. Just buy it, put monthly money in, and let them grow compoundingly. Because I can talk about stock picking, and we can get into that, and that's like a longer discussion. But today I wanted to give somebody, because the room, Shed, a lot of people don't invest regularly. This is applicable to everybody across the board, no matter where you are. But it's a discipline, right? You got to get in the habit of doing that. And if you did that like 10 years ago, 20 years ago, we're going to take a look at how that would have resulted in. So over the past years, right, 10 years, the market's up over 13% per year on a compounding basis. Yet the average investor has only returned 4.7%, right? Again, because it depends on where you buy it and where you sell it. It's not about the stock, it's about where you buy it. That's the key part. So 2019, the markets were up 31%, 2020, 18%, 2021, 30%. The 3-year compounded gain is over 100%, right? So that's something to look at. If you're not investing, you're leaving money on the table. Now, why do I say that I invest in the market? That's because the markets are designed in a way to always naturally go up. Now, not in a straight up line. We're going to have their pullbacks. We're going to have the pullbacks along the way, just like we're seeing right now. But over a course of 10 years, the market has always been higher than where it was 10 years ago. Every single time. Every single time. That's how they're designed. Because what is the S&P 500? S&P 500 is just 500 stocks, a collection of 500 stocks, right? Now, the key with that is every few years, they do a review of all the companies in the S&P 500. And then all the ones that are not performing well, they remove them. They remove all the bad companies out of that, and they put all the good companies into there. So naturally, it's designed in a way to always go up. Now, it's also part of the American culture, right? 401ks, IRAs, retirement accounts, regularly putting money in. So think about it. If we remove all the bad companies, we add all the good companies, everybody's taught in a way to invest regularly every month. So the markets are obviously designed in a way to naturally go up, right? Because if there were the same 500 stocks in the S&P that were there like 30 years ago, the market would have crashed already, right? But they remove all the bad ones. They add all the good ones. So it's naturally designed in a way to go up, but not in a straight line, right? It's not like just always going to go up. It's going to have its pullback. It's going to have these shakeouts. But the next chart that I'm going to show you is going to illustrate that. So here's the chart again of the S&P 500. So notice this little blip right here. You notice that little blip? And then we went like way up higher. That's the 2020 crash. Now, when it was happening in that moment, what did people think? It's the end of the world. I don't want to know. I don't want to invest in the markets, right? They get scared. But that's now just a blip on the chart, and we're much higher than where we were, right? We've gone through the Greece debt crisis, the debt ceiling. We've gone through the Israel-Palestine. We've gone to Russia-Ukraine. Despite everything that's happening in the world, the stock market's never been higher, right? It always goes up, but not in a straight line. It's going to have its pullbacks along the way. But if you're a patient investor and you invest regularly in the market, your money's now working for you rather than you working for your money. Now, I trade every day. I'm an active trader. I'm in and out of stocks every single day. Even this morning, I was trading. But trading it's kind of like a skill. It's not for everybody, right? It's kind of like a job. Like we're trading every day, right? But investing is something that everybody can do and have their money work for you, right? And the reason I talk about investing is because we all can have a speaking career here. We can all have great entrepreneurship, coaching, business, whatever you guys are into. But the reason I always choose to invest, even though I actively trade, is because what if something happens to me? Right? What if I can't trade anymore? What if something happens in the business? Now I'm screwed because I'm relying on that one source of income. But if I have my money working for me on the side, now that allows me the freedom to not have that worry about what if something happens, because my money's working for me and I'm set, right? So the stock market always goes up. Not smooth line, but it naturally in the long enough time frame, it will always go up. The Dow Jones was at $64 in 1921, right? The Dow peaked at 41,585 on August 30th. Now, obviously, it's much higher than even there, from even August 30th. That's a 64,876% increase. Now, just based on that little Cliff Notes version that I shared with you, where do you think the market's going to be in the year 2032, 2042, 2052, right? The most reasonable answer is higher. The most reasonable is higher. So if that's the case, then why are we not investing in it today? But on, the elections coming up, or the Ukraine war, the recession, the inflation, there's always going to be something to stop you from investing. That's what creates the markets. There's always going to be something telling you not to invest, that inner voice. That's the doubt. That's where you go back to your money beliefs and where's that really coming from? Where's that fear coming from? Because we just looked at the charts since 1920s. Think about how much stuff has happened in the world and what we've gone through since 1920s. A lot. And we've never been higher than where we were, right? So based on that, the most reasonable answer is higher. So we should be investing in it today, regardless of how high it is. Regardless if you think the recession is going to come or whatever's going to happen, 10 years later, it's not going to matter, right? So $10,000 invested in the stock market in 1936 would be worth over $54 million in 2021. $1,000 would be worth $5.4 million. $100 would be worth more than $500,000. That works out to be about a 10.6% compounded return per year. So basically, in a nutshell, your money's going to double every 6 to 7 years if you invest in the markets. Every 6 to 7 years. the sooner you start, the better it is, right? I started, I was 18, I was super lucky. I was a complete introvert on my Xbox all the time. So it's very natural for me to just trade the Xbox and now I'm just on a computer. It's the same thing. I'm still an introvert. But the lucky part was I got this when I was 18. So I set myself up. I'm like 30, I'm gonna be 33 next month. I'm set because I did all of this that I'm talking about, and look at the markets now. Every 6 to 7 years, your money's gonna double, okay? Notable market crashes, 1907, panic of 1907, 1929. We've gone through all of these, the Black Monday, the dot-com bubble, the financial crisis, the COVID drop. Market's still higher than where it was. So these are the things that people fear, but it doesn't matter in the long enough time frame, okay? The power of compounding. The earlier you start, the better it's gonna be for you. So investor number one starts at the age of 25. He sets aside $5,000 per year for 10 years. And he stops investing after the age of 34. At 65 years of age, he's gonna have almost $800,000 just from $5,000 a year, right? Investor number two starts at 35, does the same thing, sets aside $5,000 per year for 30 years, but you see how he's gonna have a good return, $612,000, but still not as much as the first investor who started early. So what I'm trying to say is time is money. The earlier you start, the better it is. It's not too late, regardless of where you're at. Think about what's gonna be 10 years from now, okay? Your number one asset in life is time. There's nothing more valuable in life than time, right? The sooner you start, the better your money's gonna work for you. Now, I'm not gonna go through this, but I want you to, go on Google, type in a compound interest calculator, and there, you're gonna be able to plug in the numbers. If I put in $1,000 in my investment account, and if I just put in, $50 a month, all right, for 40 years, what's it gonna be? Gonna be about $242,000. And I know what you guys are thinking. Well, that's not enough. Sure. Well, let's change the numbers. Now let's put in a $200 monthly contribution, or now let's put in $1,000 deposit, $200 monthly contribution over 40 years. You get to about $1 million. So with these calculations, what you can do is you can plug in the numbers for you, right? What can you do realistically? How much can you start with? The more you start with, the more you add to your account every month, well, then naturally the compounding is gonna happen faster for you. The best way to think about compounding is like a snowball. Imagine a snowball rolling down the hill. As it's rolling down the hill, what happens? It collects more and more snow. It keeps getting bigger and bigger and bigger and bigger. That's what compounding really is. You start with $1,000, maybe next year it's $1,100. But now next year you're gonna get the 10% on the $1,100. Next year you're gonna get the 10% on the increased amount, and it just keeps adding up that at the end of 10, 20 years, you're gonna be way ahead of your money, okay? So again, here's another example. $1,000 initial deposit, $1,000 a month over 40 years, $4.25 million. That's how you can think about not getting rich quick, but getting rich for sure. Like, we're gonna get there, right? It's just gonna take its time. But it's not about like getting there right now. And I think that's what a lot of people try to do with crypto and all these other things, is they wanna get there right now. I'm like, no, let's just get there for sure. Let's keep building our businesses, right? I'd rather get there for sure. And I think one of the things with investing is like you give a person a strategy that is sure to make him a millionaire in 10 years, but in the hopes of getting there in 1 year, they're gonna tweak it, they're gonna optimize it, they're gonna mess with it, and in so doing, 10 years later, they're still not there yet. Whether they're just stuck to this, they would have already gotten there. Yeah. Mistake number 5, listening to news or watching the pundits, right? We see these amazing guys on CNBC, beautiful suits, beautiful ties, and they're telling us everything to do about investing. Here's what you should be buying. Here's what you should be selling. But most hedge fund managers get less return than just if you put your money in the market yourself. That's the truth, right? We're gonna take a look at that. Hedge funds often cite, they're better at the volatile markets, but hedge funds actually underperform the market. Over the past 15 years, 92% of fund managers have underperformed the market, meaning you're better off and you get better returns by just putting it yourself into the stock market, yeah? So here's a little homework for you, right? Go to the compound interest calculator, type in what can you realistically start with, and make it a discipline, right? Make it a discipline so that the money leaves your account before other expenses get it. So whatever your businesses are, your coaching businesses, your speaking businesses, take a percentage, whatever you feel comfortable with, right? And just automatically set up in your account so it leaves your bank account and gets invested. So you don't even look at it. Sure, pay your bills first, right? Pay your bills, your rent, your expenses, cover all of that, and then technically whatever's left over should automatically be invested, right? That's the surefire way. Because if you don't do it, if you don't make it a habit, money's gonna find ways to leave the account. It just happens. So pick a percentage that's realistic for you. 5%? Can you do 5% of whatever is coming in for your income? Realistic, right? Maybe 10%. The more you do, the better you're gonna get to your goals. Like, I would love to do 30, 40%, but I live in New York City. Our expenses are too high, so it's not gonna happen. But I think 10% is something that I think realistically everybody can do here. So as you get your money coming in from your own businesses, from your coaching career, from your speaking career, take 10%, don't even look at it, buy the S&P 500, buy the NASDAQ, buy a Vanguard Total Market Index, and just tuck it aside. And then hopefully we'll meet 10, 20 years later and you'll be like, holy shit, you were right. You know? So markets underperform. Active fund managers trail the S&P, for 9th year in a row, okay? So the reason we invest is because of inflation. The value of $1 in 1975, you would need $4.81 in today's money to make up for that dollar. Because the dollar is losing value every year because of inflation. Here's a buying power. What a dollar could buy in 1975 is roughly you could buy like 10 cents worth of items today. So if you just keep your money in the account, it's just slowly losing money every year, okay? You're gonna need $4.81 in today's money to get what you could get for $1 in 1975, okay? So that is that. So who here is committing that they're actually gonna do this, like invest regularly, yeah? All right, so.
Get your information.
Sure, yeah. So I actually want to see the hands. Who's actually committing to do it?
Yeah, I don't know what
Because I want to take a picture of this, so if you don't do it, I can come after you, and because you committed. Don't commit something you don't believe in, right? But do this. I did it when I was 18. I couldn't be more grateful, right? Despite what everybody said, couldn't be more grateful. I've traded for prop firms. I coach hedge fund managers now, but more on the psychology element. They don't need to learn how to trade. They're already way better than that. But I think the reasons we don't do this is our own internal money beliefs. Gambling, is it right? Is it wrong? Right? All those things come up. Or maybe some people think money's not good, Wall Street's bad. It's all good, right? That's all you need to do. It's all good because what you're doing as you're investing in the money, it's in the end, it's helping the economy, it's helping everybody, and it's helping you get ahead of your money as well. So that's kind of what I wanted to share. The reason we invest is because of inflation. So don't pick stocks, just buy the market index funds. This is something that everybody in here can do right now. You don't need to wait to learn more. I think that's a trap we fall into is I always need to learn more. I need to get better. I need to learn more. And we get stuck in this learning loop. I just want to keep learning. I just want to keep learning. And we go from one podcast to another podcast, one book to another book, one event to another book. And I'm like, people brag about how many books they've read. And I'm like, but your life doesn't demonstrate you taking action on any of that. Right? We've all read Think and Grow Rich here, right? Everybody read it? So Napoleon Hill talks about in there what? Having a mastermind, a board of advisors, a council of men. Who here actually has that? Now, some of you may be in your Jacob's mastermind, so congrats for that, right? But whatever room you're in, get into some sort of a room, like you here. But make it a weekly habit. I meet with my mastermind group every week. We have a private community. We chat every single day because that is what Think and Grow Rich talks about. So don't just read a book. Make it a part of your life, all right? So I just want to end with like a little gift for you. Again, this is the 4-hour version of this presentation we could get into at another time. But I want to give you a free gift, okay? Now, I know what I've given you. I don't know what you've received, right? Because, again, we talk about investing. You can all go back home and say, great talk, Anmol. Thank you. I learned a lot. And you go back and life just goes back as normal. You don't actually execute on it. But the key is you have to take action, right? You actually have to do the things that are meant to be done, okay? So I wrote a book, Prepping for Success, 10 Keys for Making It in Life. Use the code VIP free. So you scan the QR code. It's going to ask you to cover shipping. But if you enter this code, you don't even have to cover that. We'll just send it to you. So this is that book that I wrote about, all the things that I've learned in my life, in my journey of trying to get better. Because one of the things I've realized is trading was the biggest personal development journey that I've ever embarked on. Like when you're risking millions of dollars every day, you'll feel your emotions, right? You'll feel it. Every day. I could be up a few $1 million. I could be down a few $1 million. Tesla's up today. Tesla's down today. That emotional roller coaster taught me a lot about myself and my emotional control. And I basically wrote a book that I wish somebody gave me like 20 years ago. Would have made life a whole lot easier. And at this point, because I had to do a lot of work on myself, I had my own money issues, money beliefs. And I attended like a lot of events, spiritual retreats, going to all these networking events, hiring coaches, hiring mentors, spent over $1 million at this point, like really working on myself. And I just took all of this down as notes to myself. And then people read it, my friends read it, they're like, these are really good. You should try to put it in a book format. And that's when I just took all the notes that I wrote for myself that I actually applied in my life and that helped my life get better. and I just put it in a book format. So I just wanted to give that to you as a free gift. It's called Prepping for Success, 10 Keys for Making It. And the biggest thing that I talk about in the book, I'm just going to leave you with one of the keys, is integrity. Yeah, integrity is the most paramount aspect. Without that, nothing works. And integrity, as I define it, is doing what you said you're going to do, and then doing it when you said you're going to do it. And doing it because it's the right thing to do, whether you feel like it or not. Right? Doing it because it's the right thing to do. And a lot of people say, you know, but I'm a person of integrity, Anmol. I'm like, really? When's the last time somebody called you and he said, hey, I'm just in the middle of something, let me call you back, and you never did? Or you ran into an old friend at the airport or a shopping mall, you were like, hey, good to see you, buddy, we should totally make attempts to catch up again, and you never follow up with them. So you just said something that you didn't mean. Think about, where's that coming from? Where's that really coming from? We're trying to look good, right, in front of other people. We're trying to be polite. But make sure the words that come out of your mouth, you really mean it. So if you're committed here to investing, make sure you go home and you actually apply it, okay, and you actually do it. So I don't know how we're doing on time, but I think, yeah, pretty much ready to go. So I want to give you this free gift. Hopefully you guys learned something. And if anybody is interested in trading and investing, feel free to just come talk to me during this event. And I'd love to chat with you, and we can go a whole lot deeper if you really want to get into like trading, which is, again, different ball game, but I could teach you that if you're interested. All right? So thank you, everybody. Take care. Thank you.